So in the first review, we will start with some basics of correlation and then move on to advanced concepts related to correlation in the coming sessions. So financial correlation risk measures the risk of loss resulting from adverse changes in correlations between financial or non-financial assets. So we've seen that when coal prices go up, steel prices come down, or vice versa. Let's say we've noticed that when coal goes up, steel also goes up. That is some historical correlation that we've calculated. Now if we base our investments based on this historical correlation, and this correlation for some reason changes during the period in question, and we have a loss because of that change in correlation, then that risk or that risk of loss will be defined as correlation risk. So a negative correlation between interest rates and commodity prices is a great example of financial correlation risk. So generally we've seen as interest rates go down, commodity prices go up. As interest rates go up, commodity prices go down. A break in that correlation may cause a loss and is a source of correlation risk. A classic example of non-financial assets being impacted by correlation risk is the correlation of sovereign debt levels and currency values that can result in financial losses for exporters. So again, the increase in a country's debt can cause the currency to devalue, and if the currency devalues, then it can be a source of fluctuation for exporters or for importers. So there is generally a correlation between different financial assets as well as non-financial assets, and we've seen that as these correlations change, there can be a profit or a loss. The risk of loss is correlation risk. Static financial correlations measures the relationship between assets for a specific time period and do not change. Examples are correlation copulas for collateralized debt obligations, value at risk, binomial default correlation model. So in all these models, what we do is that we calculate the correlation and then we input it for a future period calculation, and it is assumed that the correlation will remain the same for the period in question. In dynamic financial correlations, the co-movement of assets is studied over different periods. So over different time periods, the correlation values can change, and we try to incorporate that when we study dynamic financial correlation. So pair trading, deterministic correlation approaches, stochastic processes are examples of dynamic financial correlations that are calculated at times. So structured products is an area of increasing concern regarding correlation risk. For example, in a credit default swap, if an investor purchases $5 million of French bonds and is concerned about France defaulting, the investor can transfer the default risk by purchasing a credit default swap from Deutsche Bank that will give him a payment in case France defaults. So this is the structure. This is the investor who has exposure to the French government or the French sovereign, and he buys a credit default swap. So he pays a spread to Deutsche Bank, and Deutsche Bank will make a payment which is contingent on the French government defaulting or the French bond defaulting. So French bond is a reference asset. This is a traditional standard credit default swap structure. Now if there is a positive correlation between Deutsche Bank and France, then the investor has a wrong way risk. Now when France defaults, if we see that historically when France defaults, German banks also default. That means when the French bond will actually default, there is a high probability that Deutsche Bank will not be able to make this contingent payment. Hence, the protection that we've bought may not be effective at all. This is referred to as a wrong way risk. That is, when the deterioration in the asset correlates with the deterioration in another asset or for another investment that I have made. If France defaulting actually meant that German banks become better credit, or German banks improve in their financial situation, that would be a right way risk, because then the probability is very high that when France defaults, the Deutsche Bank will be able to make my payment, because historically I've seen that when France defaults, these German banks have a better credit quality. But if that is not the case, for example, if the correlation of default between the two is very high, then this will be a wrong way risk, because I'm trying to protect my risk against the French bond, but the protection that I'm buying itself will default while France defaults. So that is referred to as a wrong way risk. So correlation plays a pivotal role in 5 common areas of finance: investments, trading, risk management, global markets, and regulation. Now we'll first see the correlation in financial investments. So the return per se is, please recall from level 1 or level 2, or rather please recall from FRM part 1, that the return per se is not affected by correlation. So the average return for a portfolio comprised of asset X and asset Y will be the weight of asset X into the average return of X plus the weight of Y into the average return of Y. This is the expected return of the portfolio. However, the correlation does impact the risk of the portfolio. The risk of the portfolio is calculated as the weight of X square into the variance of X plus weight of Y square into the variance of Y, that is nothing but sigma square, plus 2 weight of X sigma X weight of Y sigma Y into the correlation between X and Y. So this is what the risk of the portfolio is calculated as. This can also be written as 2 into Wx into Wy into the covariance between X and Y. Covariance can be calculated as the correlation between the two assets into the standard deviation of X into the standard deviation of Y. So just for example, if we have two assets and this is their average return, or rather this is the value of the asset at the end of 2011, at the end of 2012, 2013, 14, 15, 16, so on and so forth. Similarly, this is the value of asset Y at the end of 2011, end of 2012, 13, 14, so on and so forth. We can calculate the return of X as simply the ending value minus the beginning value divided by the beginning value, which will come out to be 27.27% in this case. Similarly, for all other years, we can calculate the return. The standard deviation will then be calculated as the mean minus the deviation of each of the values. So the first value minus the mean, the second value minus the mean, squared and averaged will give us the variance. The square root of that will give us the standard deviation. So we know the method of calculating the variances, the covariances and the correlations. If you've forgotten, you can refer to the quant videos from FRM part 1. They will give you a very detailed explanation of how to calculate the correlation and the covariance between the two assets. So just remember that the sum of the deviations is divided by the number of observations minus 1, that is n minus 1 if we are working with a sample, so as to calculate the covariances, the standard deviations and the variances. Covariance is nothing but the product of the deviations averaged, and correlation is nothing but the covariance between the two assets divided by the standard deviation of X into the standard deviation of Y. So this was our historical calculation of relation over a given period between two assets. This is how we can calculate the correlation. Again, please watch the videos from Quant Part 1 to know the properties of correlation, the meaning of correlation, and how it can be used in financial analysis. We'll study more advanced concepts in the review on FRM Part 2. So this slide just elucidates the calculation, nothing that you don't already know, but just to refresh, you can always pause the video here and go through the calculations and verify them yourselves. Now, if we see the relationship between the portfolio risk and correlation, please note that return will not be impacted. If there is an asset X and asset Y, and the correlation, let's say asset X has a return of 10, asset Y has an expected return of 20%, and the correlation between them keeps varying. So let's say correlation varies from minus 0.9 to minus 0.8, 0, 0.1. Please note the maximum and minimum values can be plus 1 and minus 1, 0.2. So the correlation between the two keeps varying. However, the expected return and the expected return of Y are both the same, that is 10% and 20%. And let's assume the weight of X in the portfolio is 50% and weight of Y in the portfolio is 50%. And if we plot the return divided by risk, or rather the expected return divided by the expected risk for the portfolio, we will see that this expected return will remain the same regardless of what the correlation is, because that is just weight of X into the expected return from X plus weight of Y into the expected return from Y. The expected risk, on the other hand, will change because correlation comes into the calculation as sigma X square, WX square, WY square, sigma Y square plus 2WX, WY, correlation between X and Y, sigma X into sigma Y. So this correlation number comes in the calculation of the risk of the portfolio. And you can see that as this correlation keeps getting lower, the risk of the portfolio will keep getting lower, or this ratio will keep getting higher, the ratio of expected return upon expected risk. Now, this graph just depicts that as the correlation goes down, this ratio improves exponentially. So for a correlation of minus 1, the ratio actually becomes infinite. That is, risk can even become 0 if the correlation is exactly minus 1 between the two assets. As correlation reduces, the risk significantly reduces, hence the return upon risk ratio keeps going up. As the correlation increases, the expected risk also increases, and the return upon risk ratio will go down. So essentially what we're trying to say is, the lower the correlation between the assets in our portfolio, the lower will be the risk and the higher will be the expected return upon the expected risk ratio, or higher expected return for a lower expected risk, lower the correlation, and vice versa. So correlation in trading with the multi-assets option can also be studied. So correlation trading strategies generally involve trading assets that have prices determined by the co-movement of one or more assets. Correlation options have prices that are very sensitive to the correlation between the two assets and are referred to as multi-asset options. So we'll study both as an example. So assume the price of asset 1 and asset 2 are noted as P1 and P2 respectively, and the strike price for a call option is the predetermined price an asset can be purchased. Similarly, the strike price for a put option is a predetermined price at which an asset can be sold. So we have a strike price for the call, strike price for the put. So the payoff for a multi-asset correlation strategy will look something like this. So option on higher of the two stocks. So you get the higher of the two. So this is an option, you pay a premium, and what you will actually get as a payoff is the higher of any of the two assets, A or B, whose prices is denoted as P1 or P2. Similarly, you can have a call option on the maximum of two stocks. So it will be like a regular call option. However, the payoff, which is S minus Q or S minus K in the case of call option, will be dependent on the higher price of the two assets, that is P1 and P2. So if any of the assets goes up, your option will come in the money. Similarly, an exchange option will give you a payoff equal to the difference between the prices of the two assets. So of course, the payoffs, as we understand or we can see on all these strategies, will depend on the correlation between the two assets. You can similarly have spread or correlation based strategies. So in a spread call option, the payoff is dependent on the difference between the price of the two assets versus a pre-decided difference between the price of the two assets. So strike price is, let's say, $2. If the actual difference between the price of the two assets is greater than $2, then the option will come in the money. If the actual difference in price is less than $2, then the option will be out of the money. So we can have these kind of strategies also. In a dual strike call option, we can have two options, one for asset 1, one for asset 2. If any of the assets is greater than the strike, then the option will come in the money and the payoff will be the higher of the two, that is, whichever stock is more in the money with regards to its strike is the payoff that the option will give us. So we can structure any kind of product, guys, but just to highlight that these kind of products do exist, or people do punt on the co-movement between assets or the correlation between the movement of two assets. As always, implied volatility will always be a very important determinant of an option's price, because remember, an option is an option. The buyer has very limited, or rather the buyer of the option has no downside. So if volatility is high, the option will have good value, because if there is a high probability or there is an increased probability that the option can come in the money if the volatility is high. So the prices of these options will be highly sensitive to the covariance or correlation between the two assets, and if these correlations change, then again the value of the options can change, the implied volatility can change. Quanto option is another strategy using correlation options. So it protects a domestic investor from foreign currency risk. The financial institution selling this kind of option is unaware of how deep in the money the call will be or what the exchange rate will be when the option is exercised to convert the foreign currency to domestic currency. Lower correlation between the currencies result in higher prices for Quanto options. For example, A US investor buys a Quanto call to invest in the NSE index and protect potential gains by setting a fixed currency exchange rate USD to INR. How does the correlation between the call on the NSE index and the exchange rate impact the price of the Quanto option? So a US investor has invested in the index, but he doesn't want to take the currency exchange rate risk. So what he does is that he invests in the index, but whatever is the gain in the local currency is protected because the exchange rate is fixed. So whatever is the movement in the NSE index is what is going to be the return to the US investor, because he has fixed a currency exchange rate. Now the question is that how does the correlation between the call on the NSE index, the price of this call option, and why would somebody buy a call option on the NSE index? Because he's positive on the asset. The call option will come in the money if the NSE index goes up above the strike price. So how does the correlation between the value of this call option on the NSE index and the value of the USD INR exchange rate impact the price of the Quanto option? Just to explain the question, if NSE index goes up, the value of the call option will go up. At the same time, if INR also appreciates, is that a good thing? That's a positive correlation. So the investor will get double the returns. He will get a return on his call option, plus he will get higher money because the INR has also appreciated. However, if this would also mean that when NSE index goes down, that is, he loses value on the call option and the INR also depreciates. So if the correlation coefficient between the two is positive, then the Quanto option is not very valuable. You understand? Because it's an option. Anyways, if NSE goes down, there is no loss that the investor is having because he has bought an option. If it is a positive correlation, then does he need to protect his risk so much? Not really. He doesn't need protection in this case. So the value of the currency risk or the currency protection will not be very high. However, if there is a negative correlation, that is when the NSE index goes up or the value of the call option comes in the money, the value of the call goes up, the INR actually depreciates. The INR goes lower in value as against the USD. Then does he need protection to protect his returns or profits? Yes, he does. So in this case, the Quanto option will have a higher value because the investor needs to protect his returns in US dollar terms. He doesn't want to be impacted by this INR depreciation. So the lower the correlation between the call on the NSE index and the exchange rate, the higher will be the value of the option and vice versa. If it's a positive correlation, then he doesn't need so much protection. He will not pay too much extra value for this Quanto option. Similarly, we can have a correlation swap. So correlation swap is used to trade a fixed correlation between two or more assets with the correlation that actually occurs. So the correlation that actually occurs is unknown and is known or as the realized or stochastic correlation after the period in question happens. So the following equation calculates the realized correlation that actually occurs over a given time period over a swap for the portfolio of n assets, and rho ij is referred to as the correlation coefficient. So just like we had currency swaps, interest rate swap, we can have a correlation swap. So one side of the swap will pay based on a pre-decided correlation and will receive the actual correlation. So if the actual correlation is higher, then I will receive more and pay less. If the actual correlation is lower than the prefixed correlation, then I will give higher, that is the fixed amount, and I will receive lower, that is the actual correlation. So don't worry about the previous formula. I mean, you can just try to remember it, that the realized correlation is calculated as 2 upon n square minus n summation of the correlation between the individual assets. So we'll study that with an example, and you'll be able to better remember and understand the formula then. So the payoff is the notional into the realized minus the fixed. So he pays the fixed and he receives the realized, as we discussed. If the realized is higher, he will receive more. The realized is lower, he will pay more. So suppose a correlation swap buyer pays a fixed correlation rate of 0.3 with a notional value of $10 million for 1 year for a portfolio of 3 assets. The realized pairwise correlations of the daily log returns at the maturity of the 3 assets are between asset 2 and 1.7, between asset 3 and 1.5, and between asset 3 and 2.3. What is the correlation swap buyers pay off? So we will first calculate the realized correlation. So what he pays is 0.3, but if the 3 assets actually have 0.7, 0.5 and 0.3, then we can calculate the realized correlation as 2 upon n square minus n. Since there are 3 assets, this will be 3 square minus 3 into the sum of the correlation of the 3 assets. So it will be 0.7 plus 0.5 plus 0.3, that is 0.4833. How this formula comes, what is the derivation, you don't have to worry about it, guys, beyond the scope of the curriculum. You have to remember the average correlation, so to say, of the portfolio will be calculated as 2 upon n square minus n is the number of assets, into the summation of the correlation between the individual assets. Don't double count, only once. So 0.48 is the realized correlation and 0.3 is what he had guaranteed. So he's in the money. He's going to pay based on 0.3 and he'll receive 0.48. So people can take those bets also. That is what will be the correlation. If you think that the correlation actually will be higher, then you can enter this kind of a swap. You can take this position. Correlation can also be used for risk management, as we studied in the 5 uses. So to mitigate financial risk in the form of market risk, credit risk and operational risk is the primary goal of risk management. Value at risk is a common metric to measure market risk. So it gives you the potential loss in value for a specific period of time for a given confidence level, and the formula using the variance covariance method was the VOR of a portfolio can be calculated as the standard deviation of the portfolio multiplied by the Z value for a given confidence interval multiplied by the square root of T. In this case, we've chosen to use square root of X, where T or X is the number of trading days. Sigma is the daily volatility. So how does correlation come into picture? We know that the volatility of the portfolio includes correlation between the assets of the portfolios in its calculation. And we also studied that lower the correlation, lower is the sigma of the portfolio. Sigma, another shortcut method of calculating sigma is the beta of the investment amount, the vertical beta of the investment amount multiplied by the covariance matrix of the returns. So this is nothing, it's the same formula that we studied, wx square sigma x square, wy square sigma y square, wz square sigma z square, covariance xy, covariance yz. At FRM part 1 we studied. This is just another way of depicting the same formula with slightly different terminology. You don't need to get confused with it. So it's the same formula that we have been using since FRM part 1. So we'll do an example and understand. Assume you have a 2-asset portfolio with 10 million in asset X and 5 million in asset Y. The portfolio correlation is 0.5 and the daily standard deviation of returns are 1.2 and 1.5. What is the 10-day VAR of the portfolio for a 99% confidence level? That is an alpha equal to 2.33. So again, you can do it traditionally from the way you studied. What will be the weight of X? It will be 10 divided by 15. Weight of Y will be 5 million asset Y, so 5 upon 15. Sigma of X is given, sigma of Y is given, sigma or correlation between X and Y is given. Sigma of X is 1.2%, sigma of Y is 1.5%, and correlation between the two is given to be 0.5. So can you calculate the standard deviation of the portfolio? Yes, you can, from the same method. Wx square sigma x square plus wy square sigma y square plus 2 correlation xy, which is 0.5, into wx wy sigma x into sigma y, and then everything will be under the square root. Once you have the sigma of the portfolio, you can use that to calculate the VAR. Well, the VAR will simply be the sigma of the portfolio in absolute terms. Okay, so this will be the percentage sigma. So the absolute value of the portfolio is 15. So 15 into the sigma that you've calculated. This will be the standard deviation in dollar terms. We call it dollar standard deviation, multiplied by the confidence interval, that is 2.33, which will give us the VAR of the portfolio, or 99% of the times the 1-day loss should not exceed this value. Question asks the 10-day VAR, so we'll multiply it with the root 10. So this was the VAR 1 day. If you have to calculate the VAR 10 day, then we multiply it with root 10, and this will give you the 10-day VAR of the portfolio using the covariance or variance covariance method. So you can verify the calculation. You can use the covariance matrix approach. Another way of solving it will give you the exact same answer. So please do the calculation as I mentioned, and please verify that the VAR will come out to be 1.255 million US dollars. So this suggests that the loss will exceed $1.25 million once every 110-day period. So if you take different 10-day periods, the total loss in this 10 days will exceed 1.25 million only once in 110-day periods. 110-day periods means 1000 trading days. In a year, approximately 250 trading days. So once in 4 years, you can say the loss in a 10-day period will exceed $1.25 million. Okay, please verify. You can also study this covariance matrix approach, will give you the exact same answer, not really needed. Even if you do your traditional approach that you've studied, you'll get the exact same answer. again we can plot the relationship between the VAR and the correlation. You see, VAR is nothing, it is dependent on the standard deviation. This is the dollar standard deviation. If it's a percentage, then you multiply it with the value of the portfolio. So dollar standard deviation multiplied by the confidence level Z value multiplied by the square root of t. So the Z value remains the fixed time period we know. So the VAR essentially is dependent on the standard deviation of the portfolio. So if you were to plot VAR with correlation, it's the same plot as the standard deviation with correlation. So as the correlation decreases, we studied in the risk return or the return upon risk chart earlier, that risk falls, it falls exponentially. As the correlation goes up, risk goes up, standard deviation goes up. Whether I put VAR here or standard deviation here, the chart would still look the same. So as the correlation goes up, the risk will go up and the VAR will also go up. So just some facts and historical analysis now. So contribution of correlation to the financial crisis of 2007 to 2009. So the correlations of assets within and across different sectors and geographical regions were a major contributing factor for the financial crisis of 2007 to 2009. That is, value of assets across geographies across the world fell. So correlations were very high. The economic environment, risk attitude, new derivative products, new Coppola correlation models all contributed to this crisis because everybody was doing the same thing. So when a loss happened for everyone. Investors became more risk averse shortly after the internet bubble that began in the 1990s. So in the late 1990s, 2001 was the internet bubble. The economy and the risk environment was recovering with low credit spreads, low interest rates, low volatility. So people were risk averse, people were invested in bonds, and credit spreads were relatively lower. The overly optimistic housing market led individuals to take on more debt and buy overvalued properties by using that debt. New structured products known as collateralized debt obligations, constant proportion debt obligations, credit default swaps helped encourage more speculation in these real estate investments, in these debt markets, in these bonds, on which more further structured products were created by investment banks and financial market participants. Rating agencies, risk managers, regulators overlooked the amount of leverage that the individuals and the financial institutions were taking on, and all these set the stage for the financial crisis that initially was set off by defaults in subprime mortgage market. So subprime mortgage is basically mortgages given to lenders who are subprime, who don't have a very good credit quality. So first these people defaulted. That is, the subprime borrowers defaulted, people who did not have the ninja, so as to say, no income, no job, no assets. So that class defaulted first, and that triggered a series of losses for banks and financial institutions into much bigger losses because of the ripple on effect. So the risk managers and financial institutions, investors do not understand how to properly measure the correlation. The risk managers use newly developed correlation model for measuring the correlation in structured products. So the CDOs contained up to 125 different assets. So you can imagine how difficult it would be to measure the correlation between the assets and to calculate the correlation of the portfolio or the risk of the portfolio. So the model was designed to measure n into n minus 1 by 2 assets in structured products. So the CDO managers would need to estimate 7,750 different correlations if there were 125 different assets in the portfolio. They were further separated into several tranches based on the degree of default risk. As we studied in credit risk, there was the equity tranche, the mezzanine tranche, and the safer tranches above them. Riskiest tranche is called the equity tranche. Investors in this tranche were typically exposed to the first 3% of defaults. Mezzanine tranche, the next 3 to 7% of defaults. And the Coppola correlation model is what everybody was using and was trusting upon to monitor the default correlations across different tranches. So a lot of large hedge fund managers were short this equity tranche. They were shorting because they thought the risk was too high, and they were long the mezzanine tranche because they thought the risk was lower. Now, what this means is that the losses from the equity tranche were thought to be hedged with the gains from the mezzanine tranche. Unfortunately, huge losses led to the bankruptcy filings by several large hedge funds because the correlation properties across tranches were not correctly understood, and all tranches essentially were defaulting a lot more, or the losses were very high. So correlation played a key role in the bond market for the US automobile makers and the CDO market just prior to the financial crisis. So a junk bond rating typically leads to a major price decrease as pension funds, insurance companies, and other large institutions will sell the holdings and are not willing to hold these non-investment grade bonds. So bonds within a specific credit quality levels typically tend to be very highly correlated. Bond across credit quality levels typically have lower correlations. So when rating agencies downgraded General Motors and Ford to junk status, the equity tranche spread increased dramatically. So there was a huge loss in the short equity tranche position that a lot of these hedge funds were holding, and it caused a big loss to the hedge funds, and a lot of hedge funds declared bankruptcy. So essentially these CDOs were turning out to be very risky, and they were turning out to be more risky than what the market participants were thinking. So even the mezzanine tranches were not safe, and if you were long these mezzanine tranches, then again this whole position took a big beating, or there was a huge loss. So what we essentially found was that even though in general the equity tranches of all bonds should behave similarly, or similar credit qualities were generally highly correlated, what happened after the default of, or after the downgrade of General Motors and Ford, was that within the equity tranches the spreads increased dramatically. That is, the investment grade bonds, CDOs, equity tranches had a different spread, or a much lower spread, and for auto company bonds or auto industry bonds the spreads became very high. So for in general short equity tranche position, there are some equity tranches that went up in value and some equity tranches lost value. In general, the position lost value is what we found in the credit crisis of 2007. And at the same time, we also saw that the correlations decreased for the CDOs of investment grade bonds. So because investment grade also could now be downgraded to junk, as we saw with Ford and General Motors, so the general behavior of the CDOs was not, or the correlations that existed in the past did not continue to hold in this period of crisis. So even the mezzanine tranches now had a lower correlation amongst different categories of bonds or different categories of CDOs. So this led to losses in the mezzanine tranches as well. So the CDO market, which comprised primarily of residential mortgages, increased from 64 billion to 455 billion in 2006. There were liberal lending policies combined with overvalued real estate that created this perfect storm in the subprime mortgage market. So prices stagnated in 2006, leading to the first string of mortgage defaults. As the people's house value was falling, they didn't want to pay their mortgages. They let the mortgages default. So the real estate market collapsed and the mortgage defaults increased in 2007. CDO market, which was closely linked to mortgages, collapsed as well. So this led to a global crisis as stock and commodity markets collapsed around the world. So correlations in stock markets increased as the US stock market crashed. Default correlation in CDO markets, bond markets also increased as the value of real estate, financial stability of individuals and institutions was highly questionable. So essentially the correlation was now high in everything falling down, which is not a good thing. So across your investments, across portfolios, you were seeing losses, be it real estate, be it stock market, be it bonds, or most CDO related bonds or risky bonds, we are seeing big losses. So the CDO equity tranche spread typically decreases when default correlation increase. So a lower equity tranche spread typically leads to an increase in the value of the equity tranche. Unfortunately, the probability of default increased so dramatically in 2007 that it lowered the value of all CDO tranches, be it the equity tranche, be it the mezzanine tranche. So the default correlations across CDO tranches also increased, and increased dramatically for all residential mortgages. So even the highest quality CDO tranches, even the AAA ratings, lost 20% of their values as they were no longer protected by the lower tranches. So the equity tranche was wiped out, mezzanine tranche was wiped out, and even the AAA rating lost values. So losses were even greater for many institutions with excess leverage. If you had taken leverage and invested, then your losses were further amplified. And a lot of people had taken leverage, especially for these senior tranches, because they thought they were not very risky. And this resulted in further amplified losses for most institutions. So the leverage in the CDO market mused risk exposures for investors to be 10 to 20 times, rather caused risk exposures to be 10 to 20 times higher than the investments. So the credit default swap market had also grown very rapidly during the same period. So from 8 trillion to 60 trillion from 2004 to 2007. So these were used to hedge default risk. And they're similar to insurance products. So the CDS seller, however, needs to be financially stable to protect against these losses. So if the insurance company itself is defaulting, then there is no worth of that insurance or of that CDS that you have purchased. So the crisis revealed that the AIG group had sold $500 billion in CDSs with very little reinsurance. Lehman Brothers, we saw, had 31 times greater investments than its equity, or the leverage was 31 times, which led to its bankruptcy in 2008. So there were many derivatives transactions also that were held with many different counterparties. So which is why regulators today are in the process of developing the Basel III norms as a response to this financial crisis, that there is enhanced standards for liquidity, leverage ratios need to be lower, and financial institutions in general need to be more secure. New correlation models are also being developed, such as the Gaussian-Coppola credit value adjustment that we studied in the derivative transactions, and the wrong way risk correlation, so that your insurer shouldn't default at the same time as your reference asset is defaulting, or the CDS seller should not default at the same time as the reference asset is defaulting, because that would be a wrong way risk. So these new models now hope to address the correlated defaults in multi-asset portfolios. So a major concern for risk managers is the relationship between correlation risk and other types of risk, that is market, credit, systemic, and concentration risk. So major contributors to market risk are interest rate risk, currency, equity price risk, and commodity price risk. So the risk is typically measured in terms of VaR, as the covariance matrix method we studied for calculating VaR. So correlation is important input that goes in calculating the standard deviation of the portfolio or the risk of the portfolio. So another risk management tool is expected shortfall, that is the average value of the loss when it exceeds the VaR. So given that correlation risk refers to the risk that the correlation between the assets changes over time, the concern is that how do we adjust this variance covariance matrix approach for calculating the VOR or the expected shortfall, as the covariance that we will use in the model in the first place is going to keep changing. So we will have to reevaluate this VOR number or the expected shortfall number. So risk managers are also concerned with measuring credit risk with respect to migration risk and default risk. So migration risk is the risk that there is a downgrade or the quality of a debtor decreases following the lowering of quality rating. So lower debt quality imply higher default probabilities. So when a debt rating decreases, the present value of the underlying asset decreases, which creates a loss, even though the asset may be standard. So even though, let's say $110 are expected from this bond, now the rating is, let's say, AA. The borrower is paying us on time. If the rating gets downgraded to A, the borrower may still be paying us on time, 10, we may still recover our entire money. However, on the day this downgrade happens, the discount rate will increase and the value of this bond will go down. So there will be a notional loss that will reduce the value of our equity. So how do we account for it, and how do we provide for it is another area of concern that is now being explored more aggressively after the financial crisis. The correlation risk between a reference asset and a CDS seller is an important area of concern as we studied. It can be a wrong way risk. A high correlation increases the probability of total loss. So your asset also defaults and the CDS seller is not able to make good the contingent payment as well. So financial institutions such as mortgage companies, banks provide a variety of loans to individuals and entities. Default correlation is of critical importance to institutions in quantifying the degree that defaults will occur all at the same time. Lower default correlation generally means greater diversification and lower risk. And there are many studies that are now being done and have been done which have examined the default correlations across industries, within industries, and amongst loan types. So most default correlations we've seen are positive with the exception of energy sector. So we've only seen that when the energy sector defaults, it doesn't mean that other sectors will also default. But apart from that, we found that most other industries are positively correlated. So if the consumer sector is defaulting, it's quite likely that utilities, autos, discretionary items are also, or these industries are also defaulting. Or the slowdown, we've seen that in general is more global or more spread across in terms of default or in terms of improvement. So when things are good for all sectors. Things are bad, they're bad for all sectors except the energy sector, which doesn't seem to have much correlation. So when oil prices go down, normally it helps all the other industries. So even the oil companies may be defaulting, but doesn't mean all other sectors will also default, or at least that's what historical data suggests. Similarly, data suggests that default correlations are higher within the industry. So if one company within the industry defaults, it's quite likely others will also. So this implies that systemic factors impacting the overall market and credit risk have much more influence in defaults than individual or company specific factors. So systemic risk is seen to be of a much greater concern than idiosyncratic risk from the study of historical data. So if Chrysler defaults, Ford and GM are more likely to default rather than have benefit from the increased market share. So if Chrysler defaults, it generally means there is a slowdown in the car market. In such a case, Ford and GM will also be seeing an impact and are also more likely to default. So this is why commercial banks will see limit exposures within a specific industry. The correlations are seen to be very high, and that's why correlation risk is very important, and you need to understand if you are a financial institution today more than ever. So the key point is that creditors benefit by diversifying their exposure across industries to lower the default correlation of debtors. Risk managers can also use a term structure of default to analyze credit risk. Rating agencies provide default probabilities based on bond ratings and time to maturity. So you can construct a matrix, that is, you can have ratings on one scale, and you can see the time to maturity of the debt, 1 year, 2 year, 3 year, 4 year, and construct a term structure of the probability of default. And you can analyze that and see how the defaults are likely to be correlated in your portfolio, and you can make an attempt to diversify your portfolio. So we see that for a A rated bond, there is, if it's a 10-year bond, then there's a slightly higher probability of default. If it's a 1 year to maturity, then the low probability of default. For a CC rated bond, similarly, we've seen that this 1 year to maturity default probability is high. 10 years to maturity default probability is lower, but much higher than the A rated bond, so 5%. So similar diagrams we can construct for our portfolio and see or calculate the risk of our portfolio. So we see that the default term structure that measures the probability of default with the time to maturity of the bond increases slightly with time to maturity for most investment grade bonds. So when in general for investment grade bonds, we've seen it's an upward sloping line. As time to maturity increases, probability of default also increases. But of course, for speculative grade bonds, for CC rated bonds, we've seen slightly different probabilities. For non-investment grade bonds, the probability of default is higher in the immediate time horizon, and the longer term things are assumed to be better, or things are likely to be more normalized. That is, if the company survives in the near term distress situation, probability of default decreases over time. So Lehman Brothers filed for bankruptcy in September 08, and this was an important signal of the severity of the financial crisis and the level of systemic risk. That is, the risk of a collapse in the entire financial system. So October 2007 to March 09, the Dow Jones Industrial Average fell 50%, and only 11 stocks increased in the entire S&P 500 stocks, or the entire 500 stocks. There were only 11 that went up. Decrease in value of 489 stocks during this time reflected how a systemic financial crisis impacts the economy, with decreasing GDP, decreasing disposable income, increasing unemployment. So essentially no sector was immune. The prevalence was systemic, or the correlations were pretty high across industries, across sectors, across companies. So the systemic risk is a very important factor, and these default correlations can be very high, or these decline in values, if not default, just a loss in value, can also happen together for all your investments and can compound your woes. The sectors represented in the 11 increasing stocks were consumer staples, that is Family Dollar, Ross Stores, Walmart; educational, pharmaceuticals; agricultural, entertainment, energy, and automotive, like one automotive stock basically, which probably did well for its own some probably a new technology or something great that this company must have done. So staples and pharmaceuticals is understandable because they are often recession resistant, as people need to consume basic necessities like food and medicine. Education is also resilient, as unemployed people go back to school and want to study more. So various studies were conducted, and the relationship between the correlation of stocks was analyzed, and we found that from August 2008 to March 2009, there was a free fall in the US equity market. And during this period, at least if we measured the correlation, it increased dramatically from a pre-crisis average correlation level of 27% to a correlation of over 50% in this period. So when diversification was needed the most, almost all stocks became highly correlated, and less diversified. So if you owned 20 stocks with a low correlation, you would generally assume that your portfolio is relatively secure. Some will go down, some will go up in value. But all your historical calculations based on which you calculated the risk of your portfolio or the decline potential war, decline in value, etc., all went for a toss, because we saw that all those historical calculations had no meaning, because in this 2-year period the correlation went up dramatically and all stocks tended to fall. We saw only 11 out of 500 stocks went up. So 489 stocks essentially had a relatively high correlation, a correlation of around 0.5 for the whole portfolio. So a significant problem that any traditional risk measure would probably not have captured, because it would have based its conclusions on a correlation of 0.27, which is what was seen historically. The severity of correlation risk is greater during a systemic crisis when one considers the high correlation today of US equities with bonds and international equities. So even the international equities are getting highly correlated with US equities more and more. So I'm sure if you in the day, if you try to diversify by investing in emerging markets or investing in stocks outside the US, even that probably wouldn't have worked. Concentration risk is the risk of a financial loss from an exposure to multiple counterparties for a specific group or a specific company. It is measured by the concentration ratio. So low concentration ratio reflects that the default risk is more diversified. A high concentration ratio means that you have a higher default risk. So the concentration ratio for a creditor with 100 loans of equal size to different entities is 0.01. If a creditor has one loan to one entity, then the concentration ratio is 1. So lower the concentration ratio, more diversified is your book, lesser is your default risk. Loans can be further analyzed by grouping them into different sectors. If loan defaults are more highly concentrated within sectors, then when one loan defaults within a specific sector, it is more likely that another loan will also default, as we studied in the Chrysler, Ford, General Motor example that we discussed in the previous slide. So let's do an example and understand. So suppose a commercial bank A makes a $10 million loan to a company P, which has a 2% default probability. What is the concentration ratio and expected loss for commercial bank A under the worst scenario? Assume the loss given default is 100%. So in this case, there is no other loan that the company has made. So the bank has a concentration ratio of 1 because there is only one loan. So if there's a 2% probability of default, then the expected loss is 2% of 10 million, that is 200,000 US dollars. So a loss given default is 100%, so $200,000 is what can be expected to be lost, because it's a high concentration ratio and the entire probability of default flows through. Suppose commercial bank B makes a $5 million loan to company P and a $5 million loan to company Q. Assuming company P and Q each have 2% probability of default, what is the concentration ratio and expected loss for bank B under the worst scenario, that is both companies default? Assuming default correlation between the companies is 1 and the loss given default is 100%. So commercial bank B has a concentration ratio of 0.5, that is 1 upon 2. So it's given a $10 million loan but to two counterparties. So expected loss depends on the default correlations. So changes in the concentration ratio are directly related to the changes in the default correlation. So there's a 2% chance that company P can default independently, and there's a 2% chance that company Q can default independently, and there is some joint probability of default, that is, in this region both P and Q default. So the probability that both P and Q will default together is calculated as the probability of default of P into the probability of default of Q plus the probability of default of P into 1 minus probability of default of P into probability of default of Q into 1 minus probability of default of Q multiplied by the correlation between, or the default correlation between P and Q. So the default probability of company P is 2%. The standard deviation for company P is 0.14. Company Q in this case also has a default probability of 2%. So the standard deviation or of default will also be 0.14. So the probability of a joint default. So we studied this in the review on Copilas as well, that the probability of joint default between A and B, or probability of two joint events, will be probability of A into probability of B plus correlation into sigma A into sigma B. Sigma A or sigma P is calculated as square root of probability of default of P into 1 minus probability of P. Sigma of Q will be calculated as probability of default of Q into 1 minus the probability of default of Q. So the correlation in this case is given to be 1. That means when P defaults, Q is also likely to default and vice versa. Hence the probability of default of both P and Q will also come out to be equal to nothing but 2%. So in this case we see that the correlation was equal to 1. Hence whether you give to P or you give to Q, it doesn't really matter because both of them default together. So there is no change or no reduction in the risk. So the expected loss will still be equal to 200,000. However, if the default correlation was lower, it was 0.5, then the joint probability of default would have come out to be probability of A into probability of B plus rho sigma A into sigma B, where rho comes out to be 0.5. Now if it was 0.5, then the probability of default comes down significantly from 2% to 0.138%, and the expected loss will come out to be $13,800. So the joint probability of default needs to be also considered when we are calculating the expected default loss on a portfolio. So please note that the concentration ratio per se doesn't help. Just because the concentration ratio is half, it doesn't mean anything as long as the default correlation is very high. So the default correlation needs to be low for the concentration ratio to really have any meaning. So in this case, even though the concentration ratio was half, in the first case the probability of default still remained as 2% for the whole portfolio of 10 million. Only in the second case, when we reduced the correlation to 0.5, did the probability of default go down. If the correlation is low, then with a lower or the lower concentration ratio, it may generally mean that the risk is lower, as different bonds or different loans will not all default at the same time. So let's assume that there were 3 loans. So suppose that commercial bank C makes $3.33 million loans to companies PQR. Also assume that the default probability of each is 2%. what is the constant ratio and how will the joint probability be impacted. So the joint probability of default will become now even lower. So now probability that all three of them will default at the same time will become, or will be much lower. The calculation, like for 2 we saw that the joint probability of default, the worst case is joint probability is all three default. So instead of, in one case we saw a single $10 million loan, in the second case we saw two $5 million loans, and the worst case is a 10 million loss when both of them default. Third case we are saying $3.33 million loss, and now the worst case is, this is also 3.33, 3.33, 3.33, total of 10 million. And you see that the joint probability of default is now much lower. For a 2 case we could have calculated as simply probability of A into probability of B plus the correlation between A and B into sigma A into sigma of B, where sigma is calculated as the probability of default of A into 1 minus the probability of default of A, the square root. For a 3 the calculation is not so straightforward and it is not expected to be asked, but yeah, just remember the formula for the joint probability of default for 2 bonds or 2 investments, given the probability of default for each individually and the correlation of default between A and B. So this was some basics of correlation and how correlation impacts the risk and the probability of defaults. We'll study more about correlations in the coming sessions. Thank you. See you next time.